There is a 3-digit number that follows you everywhere. It is on file before you apply for anything, before you ask, before you even walk in the door. Your landlord checks it, your bank checks it, your car dealership checks it, some employers check it, some insurance companies use it to set your premiums. This number decides whether you get the apartment, whether you get the loan, what interest rate you pay, how much your entire financial life costs you. A bad score does not just hurt your finances, it makes everything more expensive, every single day. A great score does not just help your finances, it quietly saves you tens of thousands of dollars over the course of your life. Most people have no idea how this number actually works. This video takes you through every level, from the bottom to the very top. Find where you are, and find out exactly what it means. The 300 to 579 score. Poor. A credit score of 300 to 579 is classified as poor. And poor is the right word. Not because of your character, not because of your effort, but because of what this number costs you every single day. Let us start with the most immediate reality. You apply for an apartment. The landlord runs your credit. They see the score. They decline your application. No explanation required. The score speaks for itself. You find another landlord willing to take you, but they require a security deposit of 2 or 3 months' rent instead of the standard one. On a $1,200 apartment, that is $3,600 upfront instead of $1,200. The bad score just cost you an extra $2,400 before you even moved in. You need a car. You go to a dealership. They run your credit. You are approved because auto lenders go lower than mortgage lenders, but your interest rate is between 12 and 20%. The person with a good score sitting in the same dealership on the same day gets 5%. On a $20,000 car loan over 5 years, the good score person pays approximately $2,645 in interest. You pay approximately $13,000 in interest. Same car, same loan amount, same dealership, $10,000 difference because of 3 digits. You apply for a credit card. You are declined for standard cards. You are offered secured cards, where you deposit your own money, or subprime cards with annual fees of $75 to $100 and interest rates above 28%. Banks at this score level treat you, as we discussed in the bank video, like a fee-generating customer. Every product is designed to extract from you rather than help you. The most painful truth about a poor credit score is this: being poor is expensive. The system charges you more for everything because you have less. Higher deposits, higher interest rates, higher fees, less access. The financial penalty for having a bad score compounds on itself. Every expensive loan makes it harder to save. Harder to save makes it harder to build credit. Harder to build credit keeps the score low. The score stays low. The expensive loans continue. The 580 to 669 score, fair. A fair credit score is better than poor, but it is still significantly below where the best treatment begins. You can rent an apartment, but likely with a higher deposit. Some landlords will still decline you. Others will approve you with conditions. You can get a car loan. The interest rate drops meaningfully compared to the poor range. You might see rates between 8 and 12%, still double the rate someone with excellent credit pays, but survivable. You can get a credit card, not the best ones, not the 0% introductory offers, not the travel rewards cards with the big sign-up bonuses, but a real unsecured credit card with a modest limit. Here is the specific problem with the fair range. You are close enough to good that the gap feels bridgeable, but far enough from excellent that the financial penalties are still significant. You apply for a mortgage. You might qualify, depending on the lender and the loan type. FHA loans in the United States accept scores as low as 580 with a 3.5% down payment, but your mortgage rate will be meaningfully higher than the rate offered to someone with a good or excellent score. On a $300,000 mortgage, a half-point difference in interest rate costs you approximately $30,000 over the life of the loan. That is not a rounding error. That is a significant chunk of your financial life. The fair range is the frustration zone. Good enough to access most things, not good enough to access them cheaply. The 670 to 739 score, good 670 is a genuine threshold. Above 670, the majority of lenders will approve you for most products. The rejections largely stop. the conversations change. You qualify for standard mortgage products at competitive rates. Not the absolute best rates, those require a higher score, but rates that are close enough to not cost you dramatically over your lifetime. Your car loan rate drops into the 5 to 7% range. The difference between fair and good on a car loan saves you thousands of dollars. You start qualifying for real credit cards, cards with actual rewards, cashback, travel points, 0% introductory offers that let you make large purchases and pay them down without interest. Landlords approve you without conditions in most cases, standard deposit, standard terms. Here is what changes mentally at this level. The anxiety around credit applications begins to fade. You know you will probably be approved. The question shifts from, will I get it, to what rate will I get? That shift, from fear of rejection to negotiation about terms, is not a small thing. But the good range has a ceiling. The very best products, the best mortgage rates, the best credit card offers, the premium terms, are reserved for the tier above. You are comfortable, you are approved, but you are not getting the best deal available. The 740 to 799 score. Very good 740 is where the financial world begins to treat you generously. Mortgage lenders compete for your business at this score. You are not just approved, you are wanted. Different lenders will quote you slightly different rates, and the difference between their quotes is worth negotiating over. Your auto loan rates enter the low single digits, 3 to 5%. At this rate, the interest cost on a car loan becomes almost irrelevant compared to the cost of the car itself. Credit card companies send you their best offers, 0% for 15 to 21 months, large sign-up bonuses, premium travel cards with lounge access, high credit limits. The entire architecture of credit rewards, built for the top performers, becomes accessible to you. Landlords see your score and move past the credit check entirely. The conversation moves to lease terms. At this level, your credit score is no longer something that costs you money. It is something that saves you money. Every loan is cheaper. Every product is better. Every door opens without a fight. Here is the honest assessment of the very good range. You are getting genuinely excellent treatment everywhere. The gap between very good and exceptional, the tier above, is real, but smaller than the gaps lower down. The jump from poor to fair saves you thousands. The jump from fair to good saves you more thousands. The jump from good to very good saves you meaningful money. The jump from very good to exceptional saves you the last layer of cost. But most people at 740 and above will never feel meaningfully financially constrained by their credit score again. The 800 to 850 score. Exceptional. An exceptional credit score is not just a financial asset. It is a signal to every institution that processes your application that you are the lowest risk borrower they will ever see. At 800 and above, lenders offer you their absolute best rates. Not the advertised rates, not the rates on the poster, the actual best rates, the rates reserved for the customer they most want. Your mortgage rate is at the floor of what the market offers. On a $300,000 mortgage, at the difference between a 580 score rate and an 800 score rate, you save approximately $100,000 over 30 years. Same house, same loan, same bank. $100,000 difference. Because of the number, your credit card applications are approved instantly. The best sign-up bonuses, the highest credit limits, the lowest fees, the premium cards, the black cards, the platinum cards, the invitation-only products. These are conversations that start to become relevant. You can negotiate, not just accept. Negotiate. When you tell a lender you have an 800 score, you have leverage. They know they are competing for you. They know that if their rate is not competitive, you will go somewhere else. And they know you will qualify everywhere you go. Insurance companies in many states use credit scores as part of their pricing model. An exceptional score reduces your auto insurance and home insurance premiums. Not dramatically, but meaningfully. The exceptional score is the financial credential that works silently in your favor in every financial transaction for the rest of your life. Most people will never reach it. Not because it is impossible, but because most people do not understand exactly how the scoring system works and exactly what moves the number up. How your score is actually calculated. Your credit score is not a mystery. It is a formula. And once you understand the formula, you understand exactly which actions move the number. The most widely used score in the United States is the FICO Score. It is calculated using 5 factors, each with a specific weight. Payment history is 35% of your score. This is the single most important factor. Do you pay on time? Every time. Without exception. One missed payment can drop your score by 50 to 100 points. 1 month of being 30 days late. Reported. And it stays on your report for 7 years. Pay on time. Always. Even if it is the minimum payment. Being late is the single most damaging thing you can do to your score. Credit utilization is 30% of your score. This is the ratio of your credit card balance to your credit limit. If you have a $10,000 credit limit and carry a $5,000 balance, your utilization is 50%. That is considered high. The scoring models reward low utilization. Below 30% is good. Below 10% is excellent. 0 is not necessarily better than 1 to 5%, because having some usage shows the system you use credit responsibly. Length of credit history is 15%. How long have your accounts been open? The older your average account age, the better. This is why closing old credit cards, even ones you do not use, can hurt your score. It removes the history. Credit mix is 10%. Do you have different types of credit? Credit cards, installment loans, a mortgage? Diversity in your credit portfolio signals reliability. New credit inquiries are 10%. Every time you apply for new credit, the lender does a hard inquiry. Each hard inquiry temporarily drops your score by 5 to 10 points. Too many applications in a short period signals financial stress. What actually moves your score? The fastest path up. Understanding the formula tells you exactly where to focus your energy. The fastest way to improve a poor or fair score is to address payment history and credit utilization simultaneously. These 2 factors alone represent 65% of your score. If you have missed payments, you cannot erase them, but their impact diminishes over time. A missed payment from 3 years ago matters far less than a missed payment from 3 months ago. The most important thing you can do right now is stop missing payments from today forward. No exceptions. If you have high credit utilization, this is the fastest single thing you can fix. Paying down your credit card balances reduces your utilization ratio immediately, and utilization is reported monthly. The moment your balance drops, your score reflects it within weeks. Here is a specific strategy most people do not know about. You can request a credit limit increase without spending more. If your credit card company raises your limit from $5,000 to $10,000 and your balance stays the same, your utilization instantly halves. Your score moves up, no extra spending required. Becoming an authorized user on a family member's old credit card, one with a long history and low utilization, adds their history to your report. Immediately. For people with no credit history, a secured credit card is the standard starting point. You deposit money as collateral. You spend small amounts. You pay in full every month. Within 6 to 12 months of consistent behavior, a thin credit file begins to build. The score responds to behavior. Consistent good behavior over 12 to 24 months moves most people from poor to fair, from fair to good. The upper ranges, very good and exceptional, take longer, but they are built the same way. 1 decision at a time, 1 payment at a time, 1 month at a time. What the score actually costs you over a lifetime. Let us put real numbers on what a lifetime of bad credit costs versus a lifetime of excellent credit. Mortgage over 30 years, difference between a 580 score rate and an 800 score rate, approximately $100,000. Auto loans over a lifetime, assuming you finance 3 to 4 cars over 40 years, approximately $30,000 to $50,000 difference. Credit card interest. A poor score forces you into high-rate cards and keeps you there. Thousands of dollars annually for years. Higher insurance premiums. States where credit is used in pricing. Hundreds per year over decades. Higher security deposits on rentals, 2 or 3 months instead of 1. Thousands of dollars sitting as locked capital. The total lifetime financial cost of having a poor credit score compared to an excellent one is conservatively estimated between $150,000 and $300,000. That is not a theoretical number. That is the accumulated cost of every loan that was more expensive, every rate that was higher, every deposit that was larger, every product that was worse. 300 points on a 3-digit scale, $150,000 to $300,000. Every point on that scale is worth money. Real money. Money that either stays in your pocket or flows to lenders and landlords and insurance companies. The score is not just a number, it is the price you pay for your financial past and the discount you earn on your financial future. Let us bring everything together. Your credit score runs from 300 to 850. Poor, fair, good, very good, exceptional. At the bottom, everything costs more. Deposits are higher, interest rates are brutal, doors close before you can knock. At the top, everything costs less. Rates are the best available. Products are the best available. Doors open before you arrive. The score is calculated on 5 factors. Payment history at 35% is the most important. Credit utilization at 30% is the most fixable quickly. Length of history, credit mix, new inquiries. The fastest path up, pay on time from today forward. Reduce utilization immediately. Request credit limit increases. Avoid unnecessary hard inquiries. The lifetime cost difference between a poor score and an exceptional one, conservatively $150,000 to $300,000. The score follows you. But it is not fixed. It is a reflection of behavior. And behavior can change. Every payment you make on time is a point in the right direction. Every balance you pay down is a point in the right direction. Every month of consistent, responsible behavior moves the number. The bank treats you according to this number. As we discussed in the bank video, the better your number, the better the treatment. The lower your number, the more you pay. Move the number. And watch how the world moves with it. This is not financial advice. Please consult a qualified financial professional before making any financial decisions. Check out other Broke Monkey videos for more financial topics explained simply and clearly. If you want to support this channel so we can keep making these videos, check out the link below. Apes Together Strong.